Hi, everybody. Welcome to today's webinar. I gave it a few minutes for everyone to get in, so I think we'll go ahead and get started. Good afternoon and welcome to RiskScout's monthly webinar. RiskScout is committed to providing insightful, thought-provoking content to bankers interested in starting and growing new business lines at their financial institutions. We provide a mix of personal and professional development to give you the tools you need to be successful. My name is Kristen Parker, and I'm the Director of Compliance at RiskScout. Joining me on the call is Ryan McInerney. He's the Principal Product Strategist here at RiskScout. This month's webinar is entitled Your 2023 Strategic Plan, Growing New Deposits, Now What? And this will help you understand the opportunities and path to serving new and underserved markets to grow your deposits. Following the webinar, all registrants will receive a link to the recording via email. Our presenters will leave you some time towards the end of our hour for our registrants to pose any questions. If you have questions you'd like to ask, please put them in the chat box in the lower right corner of your screen. I think that takes care of it for housekeeping, so I will turn it over to Ryan.
All right, so welcome everybody. As Kristen mentioned, we're going to go over a little bit of what we expect in a strategic plan when looking for deposits and some of the things that we see different institutions do when they're trying to grow that deposit base.
I suppose we should probably a little bit of our background, Brian, probably before we start.
Yeah, please, after you.
Yeah, so like I said in the beginning, I'm the Director of Compliance here at RiskScout. I've been in banking for close to 20 years, with most of that in the compliance BSA AML world. I have been a BSA officer myself. I've been on the business development side, so I very much know how hard it is to get business in the first place and then maintain that business in-house. And we definitely want to take into consideration what it's like to grow new deposits or grow as an institution altogether, as well as keep those clients and still maintain a compliant BSA program. So I'm excited to be here with you to talk through this today with Brian. Ryan?
All right, and so my background is I was formerly a OCC regulator. I did time in mid-sized community bank supervision, large bank supervision, and then some different specialty groups such as credit and compliance. On the deposit side, I'm fortunate to have previously been certified as a financial risk manager, so I have a lot of expertise in terms of structuring balance sheets and making sure that when we're building these programs out that we're not taking any sort of outsized risk due to a concentration or otherwise. So today's agenda, we're going to go through a few key considerations. We'll be assessing market value, what the relative ROI is for that, filtering and vetting any potential prospects, potential members, customers, things like that, so that they're within your risk appetite, navigating the decision-making process, building the correct team, which I think we're all more than aware of is really, really important in this sort of thing, overcoming regulatory burdens, which I don't think I should be blamed for directly, but a lot of that is coming from your regulator, and scaling your program for success. So typically with RiskScout, we support a lot of individuals with new and existing underserved markets. So that could be fintechs, could be payments companies, it could be money service businesses, it could be cannabis. It could really be all over the map. And a lot of the rewards for joining in with these different types of markets will be the deposits, the loans, merchant processing, and insurance. So given today that we're focusing on DDA, we made that one the green block for you. And there is a lot to be had in terms of the deposit opportunity in many of these different markets. So we'll assess looking at that today.
All right, well, when we talk about assessing market value, what does that really mean? It really essentially is the juice worth the squeeze? Is it going to be worth it for your financial institution to dive into a market that is in your risk appetite? There's a lot of different factors in assessing a market in general. You have varying ways to get to the end conclusion, but really starting and understanding the demographics of your financial institution's footprint is relevant to the cause here. You really need to understand who is banking or who is living in the market that you are banking And I say this because we talk to market presidents all the time, CEOs at financial institutions all the time that are very much, well, that's not happening in my backyard. So none of those are in my state. So we're not going to launch a program like that. When very well you pull the numbers and they have hundreds, if not thousands of licensed businesses to operate as money service businesses or hemp businesses or cannabis businesses, or just your general non-resident alien population, those things like that. When you don't understand your market that you're serving or that lives in your area, you're really not serving your purpose as potentially a community financial institution, because you're kind of turning a blind eye to the needs in that community. Now, it doesn't mean that you need to go out and bank all of them if they don't fit your risk appetite, but just simply knowing who's in your footprint is critical to just not only if you want to go venture into a new business opportunity, but also just from your general risk assessment standpoint. You need to be knowing who may be trying to bank with you at some point, because the truth of the matter is that if these businesses, if none of these financial institutions in their area are serving these higher risk type markets, then they're going to find another way to get banking services, and they may come into your institution under the guise of a business type of business that you do serve. So the likelihood that you're actually serving markets that you say don't exist in your area or that actually do, it's probably an incorrect statement. You likely are serving these types of clients. You may just not know it. Reviewing what other products and services are being offered by other financial institutions in your footprint is really critical to understanding really what markets do exist. That's one step in understanding who's in your footprint, but it also may help you understand, maybe you've identified some markets that are in your footprint that other institutions have opted not to serve yet, or don't realize maybe they are serving under the guise of something else. It may show you that there's opportunity in that market to serve. The other thing about researching financial institutions in your market is understanding product offerings and pricing at those other institutions. We talk to institutions a lot all over the United States that really are struggling from the pricing perspective. It really does range on what products and services you are offering. It also ranges heavily on the market that you serve. So if you take, for instance, the state of Oklahoma, if you're serving cannabis, you're not going to get the same monthly reoccurring fees from these clients maybe that you would in a different state like Connecticut or California or one of those kind of states. If because Oklahoma is really saturated with a lot of cannabis licensing, and a lot of institutions out there in that state are serving that industry. So the pricing has dropped significantly from when they first got into them to cannabis banking than it is now. So it's really important to assess not only at the time that you're considering potentially banking a certain market, but also to continually reassess that. You'll also want to consider evaluating your local and state laws relevant to your market. This can start to help uncover some compliance burdens that may come up or some reputational concerns for clients. You may have a community bank or credit union that is a little bit more conservative in its customer base. We actually do serve several of those types of institutions that really want to serve their community out there and bank the underbanked, but they're afraid from a stakeholder standpoint, from a customer base standpoint, that those customers are more conservative, that they wouldn't necessarily bank with them if they know they served a certain industry like cannabis. So there are ways to mitigate around those type of concerns, but you'll want to be abreast of potential laws in either local or state that could affect how those businesses should be operating, because it could essentially affect how you are monitoring for certain events with those types of clients.
Yep. And one piece to add on the market size side of things is we're looking at that market size to make sure that the market really is large enough to support the amount of deposits we want to grow. So if your strategic plan is calling for X number of deposits or X percentage in deposits, and you're considering entering a new market to do so, unless you're doing multiple new markets or something along those lines, you really want to make sure what you're entering into can realistically achieve what your strategic goal is. Another piece on that is when you're thinking about pricing based on the market size that you're in. If you have, say, some high cost non-core deposits like FHLB borrowings or brokered deposits, something like that, you might be able to convince different stakeholders in your institution to offer a lower rate, drive in more of those new deposits so that that offset in your liquidity costs can partially offset getting a lower price for the actual account, which does lead directly into the mapping out a realistic ROI. And so one thing to consider when we are looking at the return on investment is that it should be justified and it should be risk-based. So if you do have alternative options that are in a lower risk category, and say, for example, you have a medium to high risk new market, and then you have a low risk market. If it's only a 1% premium in terms of your return, then that might not be worth the additional level of risk. However, in addition to the ROI, if there's a lot more in liquidity in that newer market, that could be part of that risk-based and justified alternative. So really just mapping out what those different options are and presenting that to stakeholders at the institution, saying, these are the reasons we feel like it is more important to go into X market. It's because we get X percentage more deposits, and even though there is a slightly higher level of risk, that's worth it because of these financial metrics. You really want to support that case. And then, it's really important to talk about what's the initial cost, what's the ongoing investment. So some of those questions on the right are going to be, as you're starting to maintain this program, what's going to be the scale up? What's going to be the cost to have more people? What's going to be the training cost? That sort of thing. So those are all some good questions to ask if you are trying to determine what the ROI is. It's also very important to have a drop dead point, or a point that essentially, if the program isn't working out the way you think it's going to, that there's a number there for you to start understanding when you need to exit the area. If you're losing money on it, or if you're not gaining those deposits that you expected, it might be time to evaluate an alternative. And then lastly, considering scalability. And we'll go through a little bit of a case study later in this presentation, but if you are going to continue to scale the program and you need more customers or more members to gather those deposits, are you going to need technology? Are you going to need staff? And what's the plan for implementing either of those?
All right, well, when it comes to navigating the decision process, after you have completed the kind of thinking through and assessing the market that you really want to serve, like we talked about in the first slide, and then discussing and walking through the ROI, which Ryan said we would go and dig into in a little bit, it's really about going through that decisioning process with your board of directors, your key stakeholders, and your regulators. So in order to really give them the holistic picture, you need to be completing a market-specific risk assessment. Your general BSA risk assessment won't do the trick. It's all about understanding the true risks that are associated with that certain program. So whether it's strictly cannabis, money service businesses, ATMs, when you're first launching a program, you need it to be market specific. After you launch your program, you can start to migrate that into your existing BSA risk assessment that maybe you do on an annual basis. But to begin with, it needs to be a separate endeavor. The risk assessment also needs to not just be specific to BSA risks, but all lines of businesses. Lots of times at institutions, I see them hone in so specifically on BSA AML compliance, which is very important, but it is not the only type of risk that exists. So whether you need to consider whether you're lending to these folks, offering merchant services, so on and so forth. If you are, you need to include those in your risk assessment and understand how, even if you're not offering those services, how are you going to stop your lenders from potentially offering services, so on and so forth. It's all about really taking that and doing some soul searching during that risk assessment. And it's okay if you come out and you say, I've got nothing laid out to be able to do this yet. That's the reality of most programs that start from inception. Maybe you have nothing, maybe you have half, but that risk assessment is going to tell you that story that you need to be able to say, okay, if we really want to do this, these are the risks, and this is how we're going to mitigate those risks. You need to present those risk assessment findings, your market research, and your ROI to key stakeholders. Best practices for that include your presentations to your key stakeholders should be thorough but concise. The attention span of higher level executives is often very short because they have a lot on their plate. That's not meant to be offensive to anyone or any of them in general. It's just the nature of it. They have a lot of, this is just probably a small fish to fry in some respects to their overall picture. So you want to make sure that you are getting your point across in a meaningful and effective way. A lot of times pictures are worth 1,000 words to some people. So adding some type of informational graphics for them to understand the opportunities versus where you're at today, where you want to be at, and what the future state of this program might look like. You need to be also prepared for some credible challenges from the board of directors on your key findings. You will find a lot of times in institutions, you need to be directing your board of director conversation as if they perhaps maybe never were a banker. Maybe they know enough to be dangerous, but don't quite understand what it's like to live in the shoes of the people who are going to actually be running this program from a day-to-day basis and having to speak to the regulators themselves, even though they are ultimately responsible for the program. Is the reality of it is it's hard to find a board member a lot of times that is really knows their ins and outs of banking in general. So it's good to have some good robust arguments ready to be your supporting argument for the things that you're helping bring up as potential key concerns and the things that you're asking for to help mitigate those key concerns. And then you're going to want to discuss the proposed new program with your regulators. The best practice is to never, ever launch a program without letting your regulators know. You don't want to catch them off guard. Should you be asking them for permission to get into this program? Well, that really probably depends a lot on the state of your compliance program. If you are under any regulatory action, that may be something that you need to address with them and ask permission for. Most of the time, it's we are going to do this situation. Can you share some best practices with me? And after your program launches, you want to share updates with your regulators on a set reoccurring cadence so they're not caught off guard during exam time. We actually worked with an institution that launched a cannabis banking program, and they informed their regulators, went through the motions like they were supposed to in the beginning, let them know they were getting into it. They stopped updating their regulator, probably a month or two after they launched the program. When the regulator came in, she was under the impression that they still only had about 10 cannabis clients, when in reality they had 250. And so that program had grown so much over the year that regulator wasn't prepared with the right staffing to come in and help really thoroughly evaluate that program along with all the other BSA AML compliance duties that are due. So that set the exam off on a really sour note. So it's best to keep them up to date on some type of recurring cadence. Doesn't need to be monthly, but let them know and be informed so they can feel that they are aware of what risks you have, and then they can be staffed appropriately for when they come in.
So when you begin scaling the program, some of the risks to think about would include credit risk, liquidity risk, and concentration risk. So starting off on the credit risk side of things, when you're considering if you are going to offer lending for whatever market you're entering into, particularly if maybe it's sort of business banking relationship and that comes with the deposits, you want to be thinking about what's the underwriting and loan grading and if there are risks specific to that industry. So for example, if you're working with something that's a heavily licensed product, what's your repossession plan? What's the disposition plan? Do you have individuals on staff who are qualified to actually repossess that product? Or do you have a contractor, third party that would be able to actually repossess and sell that product? On the liquidity side, a lot of times one of the biggest risks we'll see with some of these new markets will be a larger, say, employer or a larger overarching type of entity where you have a lot of depositors rolling up into that single type entity. So if something was going to happen to that entity, then you lose a lot more deposits than just the business in that area. I think in this case, that's probably not going to be one of the biggest issues, but some of the bigger ones might be an actual larger depositor. So the business itself versus employees of the business. And when we're thinking about that, what would be some of the alternatives for replacing that funding source? Would it be non-core funding? Would it be potential other markets or other depositors that we'd try and roll in there? And then how would that affect the overall financial profile of the institution? The liquidity risk really starts to roll directly into the concentration risk, because if there are concentrations either geographically or with a single depositor, then we want to be thinking about that in our liquidity plan. So one thing to consider on the concentration side, if you are running any sort of scenarios or tasks that you're presenting to the board of directors, one good one would be if it's a heavily licensed market, then saying if we were to lose that licensing or that legality in X geography, whether that be a county, a state, or otherwise, how would that affect the markets that, or how would that affect the deposits that were affected by that market? With all of that, you should be setting limits that are reasonable and make sure that the limits consider what the end result on NOI would be. And then when you're thinking about those limits as well, making sure that there are different triggers as you approach them. So there are actions that the financial institution is taking as you get close to breaching those. So there might be early warning indicator 1 is when you've lost 50% of that deposit pool. Early indicator 2 might be 60, and then all hands on deck might be 70 when the limit is fully breached.
All right, staffing the team. Staffing the team is, we all know staffing any team right now in banking seems to be a difficult feat, but especially in the BSA AML world, there seems to be somehow a lack of BSA AML compliance professionals, but yet I see all of these postings on LinkedIn of people who are looking for compliance jobs that had it. So there seems to be a real disconnect of really getting people in these roles that are equipped to do the job efficiently and effectively. When you're talking about designing a program for higher risk type clients, when we say the words higher risk, what we mean is just somebody who causes just a bit more of a regulatory burden than your typical run-of-the-mill compliance or run-of-the-mill customers would. That means it could be not just your cannabis or your crypto or your ATMs. It could be your, maybe you have a concentration of politically exposed persons, non-resident aliens, so on and so forth. It straddles both individuals and businesses. But regardless, if you have a program like this, any of those, you really need a designated subject matter expert that owns the program. This is someone who is going to be the one who keeps abreast of the ever-changing, potentially regulatory expectations with these types of clients that you have. You always need to be contingency planning for the loss of that SME too. And it's okay if your institution has someone who is slightly an SME, but doesn't quite have the time because maybe you have smaller staffing to really be the one that's taking a pulse check on the regulatory updates and all that. It's okay to partner with a third party subject matter expert that helps you keep your staff abreast of those. But regardless, whether you are partnering with an SME or you have an SME on staff or both, you really need to be contingency planning for the loss of that SME to your program. And just speaking from my own experience, I came from an institution where I had launched one of the very first hemp programs in the United States after the Farm Bill passed. And when that occurred, the program launched and very, very quickly gained momentum because it was one of the early adopters. So it was a really robust program. It was very well funded. It had a lot of good fee income and deposits. I was having to run that program manually because RiskScout did not exist yet. And so I was running that off of tools like Excel, calendar reminders for certain things. I used somewhat outdated system of traditional transaction monitoring, so that wasn't a big help in running a program like this. I preached and I preached and I preached about having contingency planning for in case I left, and I guess they just thought I was going to work there forever and didn't execute any contingency planning. So when I decided to leave to my next adventure, which happened to be RiskScout, they had nobody to pick up the program and run with it. So because of that, they had to close the program down. That was a lot of time, a lot of investment into that program that was just basically flushed at that point because there was no one to take it over. So what I like to make sure people know is that, does that backup SME need to know the ins and outs of everything like your current SME? Maybe not necessarily, but they need to have the right tools available to them to be able to pick up the program and start to put the pieces of the puzzle together to run that successfully. And a lot of times you're only going to find that if you have a tool that allows you to be able to run that program through there that someone else can just pick up and run with. So you want to also consider automating manual processes with software to reduce staffing needs. There's a lot of times, when I was working on Excel spreadsheets or through calendar reminders, or the notebook I left beside my bed at night when I'd wake up and remember I forgot to follow up with someone, that's not sustainable and it's not scalable. So there are things that you need to consider about adding between staffing or technology. Sometimes you need both, but a lot of times your technology can help. If it's the right technology, it can help with that burden and help automate a lot of those processes without automating to the point where your BSA compliance officer is uncomfortable with the automation. So there's a fine balance here, but it is something to consider because a program that is going to scale is either going to need technology or staffing. And a lot of times, just speaking as cautionary tale on my end, because I ran a program pretty successfully on my own, when I decided that I was maxed out of capacity and asked for help, I didn't get the help that I wanted or I needed because I waited too late to express. I could do it all on my own. So a cautionary tale when you're going in and you're building a program, make sure you're thinking through what it looks like long term. Yeah, if you can do it now, great, by yourself. But what's the goals of that institution? Where is that going to take you from a staffing perspective? Because us professionals, BSA compliance professionals, will do a lot of times whatever it takes to keep their program afloat and doing the responsible right thing. And that could be at the loss of our own mental or physical health, right? We don't want that. So think about it long term and try to start your program with everybody being on the same page of what it's going to take from a technology and a staffing standpoint.
All right, so we're going to have quite a few slides here on the case study kind of portion for this ROI application and deposit gathering. I will say, if any of you have seen me present in person, you'll know I wave my hands a lot. So as we're looking at some of these slides, I would be pointing at things, so I will point to the colored boxes instead. The reason we're starting off with the process in general is I like to talk about this chemist, and his chemist, the chemist name is, I believe it's like Progene or Prigogine. And Prigogine talks about how evolution started with dissipative structures. And so a dissipative structure is something that receives energy out of entropy. So as something's wasting away, they take that waste process and reuse the energy for something else. So think in the human body, that's the heat that we get from doing different processes, and then that heat is used for other things. So when we're looking through the operational process and we're saying a prospect's applying, the branch employee is doing some work, then business development's doing work, the operations team, each of those transfer points is a place where we're probably wasting time. And if things are going back and forth between those different departments, then we're probably wasting more time and losing more of that energy. So what we're really going to dig through here is how this matters in terms of optimizing for the number of deposit accounts you can actually support at the institution. Okay, and some of these assumptions, which I'm sure nobody is actually going to remember because it's kind of hard to remember each one of these numbers. The biggest thing to think about here, right, is the branch employees are going to be the lowest in terms of cost, but they're also going to have the highest in terms of available hours. And that's going to scale as we go down the line towards the risk team, where we're thinking about like BSA, risk professionals, who are probably the most expensive in this process, but have the least amount of time relative to the rest of the group. So in example case 1, this is a non-optimized program. And so what we're seeing is there's a bottleneck on the risk side of things. As a result of that bottleneck, because risk is taking 2 hours per customer, they're only able to service 40 different customers. As a result of that, we're looking at lower amounts of revenue. And then if we only have 40 accounts, we're looking at fewer deposit accounts at the same time. So the idea here would be, what can we do to minimize this sort of load on the risk team, maybe diversify some of that work across different areas in the financial institution so that we can have more customers in our portfolio. Okay, so example case 2 would be no software, no changes in staffing, nothing like that. But what the financial institution might have done is created some sort of form or some sort of process for the branch employee to do more work up front. Now, given the branch employee is not going to be as effective as the risk employee, what we've done for the assumptions here is the risk employee has reduced by a half hour per customer, and the branch employee has increased by an hour per customer. If we were able to do this, and this was simply a PDF or some other web-based form, we would be able to scale up to 53 serviceable customers. And if we just switch to the next slide, we'll see that's 13 more serviceable customers per month. That's also a 2% reduction in the operational cost per customer. So not only are we being able to have more customers in our portfolio, which is thereby increasing the number of deposits we have, we're also reducing the operational expenses at the same time, which is helping us in the bottom line. So this optimization among the different staff members and between the different divisions is going to be incredibly important in how many deposits we can actually have. Now, in this case, which is the second case versus the first one, which was just that slight shift in responsibilities, this would be some sort of kind of robotic process automation or other type of automation. Now, in this, we actually kept this relatively conservative, so it's about a 20% reduction on the operations and the risk teams. When we show actual case studies of different softwares that are used for this, it's typically much more impactful than that. So I'd like to just bring the point up that even when we're looking at this relatively marginal increase in efficiency by automating some of these tasks, and some of those tasks could be information gathering, it could be sending out applications, it could be notification to different staffs for doing reviews, that sort of thing. We're adding another 13 serviceable customers again, and we're continuing to reduce the amount of cost on a per customer basis. So in this instance, now we have 66 serviceable customers, and that's comparing to the 53 in the slight change methodology, slight change case, where we just had a form going to the branch employees, and that's considering 40 when there was no optimization in the program. And so this is that full kind of breakdown between all of those. We see an increased gross profit margin when we're looking at automation, and when we're looking at really spreading that workload out among the different branches. And we're also looking at bottom line, significantly more profit, and we're achieving that profit more effectively. So it's really important when we're thinking about any of these programs to make sure that things are flowing smoothly and we're not losing any of that energy through the different transfer points in the program.
All right. Well, when we're talking about addressing potential roadblocks here, we're talking about potential regulatory hurdles that may occur. And those can be in the form of many, many different things. But to start at the root of what you should be looking for, it's really important to understand regulations specific to the market you wish to serve. Sometimes that's difficult. We live in a somewhat vague BSA AML world. We read our memo guidances that come out, the FFIEC manual. We get suggestions of how to do things sometimes. In the cannabis world, there is no regulation. We have a 3.5-page to 4-page document from 2014 of FinCEN's MRB guidance telling us suggested things to do. There's a reason for only giving people certain suggestions to do this, because not everybody's going to have the same tool set, the same risk appetite, the same this, that, the other, for them to give a cookie cutter program. There's pros and cons to that. The pros being that you have the ability to create a program that is efficient and effective and compare to what your goals are. You can build a reasonable and achievable program because of that. There are certain things that the regulators do expect you to do. They expect to see, they expect certain best practices to be adhered to, but they're not going to come with a checklist that says you're not doing this, you're doing that, you're doing it a certain way, this other institution is doing it this way, you should do it better that way. You may get some feedback that there are better, more efficient or effective ways to do certain things. But that's why really talking to your regulators prior to you launching and then keeping that relationship with them is a really good best practice, because having that relationship allows you to be able to pick up the phone and ask what these other institutions are doing, ask certain scenarios, what they've seen them before. I had a great relationship with my regulators where I could email them and they would give me some advice. Did I always follow it? No, but at least I knew what they were seeing at other institutions so that I could better match and understand what the true risks are happening within my footprint with similar type clients. You also want to consider reaching out to financial professionals already serving the industry. Bankers will talk to you a lot of times. There's enough of this business to go around a lot of times. They can't be the primary institution serving them, nor do they want to be, a lot of times anyway. So they really want to help spread that wealth out to other institutions, and they are willing to talk because they want somebody to help them just as much as they want to be helped. So there's a lot of these little tight knit groups of bankers that really are in this industry together that will help share best practices with each other, pick each other's brains, say, what are you seeing here? We're seeing this. What can we do better collectively as financial providers to serve these markets better, more efficiently, more effectively, and more internally be successful as a team? You want to review how your regulatory requirements may affect your staffing. So this is part of your risk assessment process a lot of times, is evaluating your existing tools and how they will help automate regulatory expectations for your new program. So I mentioned how sometimes our guidance is vague. Well, what really comes down to when the regulators come in is reviewing your policies and your procedures to see if you're really executing your program like you say you are, and it's a reasonable and achievable program. You will need to prove that you are actually doing the things you say you're doing in your policies and procedures on a sampled basis. You'll want to ensure that you have a robust documentation process in place for all of that proof as well. There are ways to, so if your institution is saying, I reach out to my clients once a quarter to obtain X, Y, and Z. Well, if you say you're doing that, you need to be doing that, and it's going to be sampled for. Now, in a traditional method, the life I used to live, would be reaching out to your business development officer who reaches out to the client, who tells them you need a thing. The client, maybe the business development officer miscommunicated it. Maybe there's a language barrier there. The client then has to obtain that documentation. They send the documentation back to the business development officer that sends it back to you. And before you know it, it's been 6 months and you say you do it quarterly. Now, is that a dramatic scenario? No, it's not actually. That's pretty much reality in traditional banking. So if you say you're doing certain things quarterly, think of ways to help automate that process. So if you're saying you're going to go collect this information quarterly, we'll find a way that you can automate that collection from the client so that it's a better employee experience, it's a better customer experience. And that business development officer isn't having to play that middleman or woman. They're out there actually being able to go beat the streets and make their sales. You want to also ensure staffing is trained to execute regulatory requirements and keep abreast of changing regulatory expectations. The things that we used to do for hemp banking in 2018 looks pretty significantly different than what we do for hemp banking in 2023. That's because we have our guidance out there. We just got really conservative when we launched hemp banking to begin with, and as we've grown and learned and the market's changed and regulators have become more comfortable and we've learned best practices from other institutions and other examiners that have gone through, looking at a hemp banking program, the expectations have changed. They've lessened somewhat burden-wise, and maybe in other areas they've gotten harder. But the point is that it's changed over time, and your program that you create on, January 1st, 2023 may not even look even remotely close to the same thing in 2025, 2024 even, because you are keeping abreast of those changes, those expectations, and those best practices. And then you also want to ensure your key stakeholders understand regulatory expectations. Your board of directors should have a thorough understanding of the market-specific regulatory expectations for your program. Again, traditionally, board of directors are not former bankers. Maybe they are accountants. Maybe they owned a credit card processing company at some point. Maybe they've never been in banking their whole life. So really help them understand what the regulatory expectations are in a concise but meaningful manner to them. Because when you ensure the key stakeholders understand that regulatory expectations may change over time, you are also setting the expectations that you may need them to invest further into your program. So again, I'm just speaking from experience here. The program I created in 2018, even by mid-2018, looked very, very different. And I needed further investment from my board of directors, but I didn't lay the right expectations with them because I didn't know what to expect. So learn from my mistakes in this scenario and just watch over time how it changes, and know that you've done the right thing by laying those expectations with your board of directors, that this may change over time, but we are keeping abreast of this so that we can ensure that we're doing the right thing by our institution by maintaining the safety and soundness of the institution while still providing a really robust customer experience. And then finding prospects that fit your financial institution is really critical. A lot of times there is if you build it, they will come scenario when you launch programs that are for higher risk clients because they are severely underbanked. When you get into that scenario, these underbanked markets, they are vast in the number of people and businesses that are not being banked, and they talk. And so once somebody finds somebody that will serve them in the banking capacity, that word spreads like wildfire a lot of times. So you want to make sure that you have the right pieces of the puzzle in place to be able to ensure that you are spending time on prospects that fit your risk appetite. You will get a lot of garbage in, garbage out that doesn't fit your risk appetite if you don't have a way to filter prospects that are coming to your institution. You need to first start with that by understanding and laying out and defining throughout the institution from the top down, what is your risk appetite? And then understand how those type of businesses would fit into your risk appetite. So you want to be able to filter for the right prospects without your staffing having to spin wheels on ones that do not fit you, wouldn't fit your risk appetite to begin with. And then there's a trust but verify factor. So when you are launching a program and then you are letting people come apply there, it should not be you turn the faucet on and you let everybody in. First of all, again, it goes, what's going to fit my risk appetite? And truly, this prospect looks like they might fit my risk appetite. I need to vet to make sure. So you need to ensure you have a robust due diligence process specific to the industry you are serving. That doesn't just stop at the time that they are your prospect to becoming your customer or member, but it also goes for the life of that relationship with that customer or member. You need to have some type of ongoing due diligence to ensure that the business activity that's occurring in the accounts is still commensurate with the stated nature of the business. And the only way you're going to understand that that's occurring is if you still have a robust understanding of that individual or business's operations, so that you can make sure that those two align together. It's also about training each line of business to be able to detect and redirect prospects to the right line of business prior to vetting, prior to onboarding. I cannot tell you enough how many people will go rogue and just say, yeah, well, thank you, and then just have their account officer open up the account for them, and you just happen to find them because an alert pops up on your transaction monitoring system. I'm not saying that people are trying to do that purposefully. Sometimes, yes, they are, because they don't want to have to send somebody through all of the due diligence process. The due diligence process exists for a reason, to protect your institution, to ensure that you're banking somebody that is legitimate and in with risk appetite. So training each line of business on proper vetting prior to onboarding and detecting those clients or those prospects rather, and sending them to the right line of business to do their work of ensuring that these are the right type of prospects is critical to a successful program. This is just a quick example here of how you, let me back up for a second. I wish I had this when I had my program. I didn't have a way to really properly vet people unless it was, through this SharePoint PDF that people would print out, give the client, and send it back to me, and then I would try to finagle my way around finding and legitimizing these businesses, doing my due diligence process. It was a very clunky type process for everybody involved. This is just one example of a way of streamlining that, and this is how our software at RiskScout works. We're essentially the higher risk business. If they are higher risk, then they go through the application process and vetting process through RiskScout. If the application is then denied after that, then you would follow your normal account declination procedures. But if you happen to go through the motions and vet out these clients, and then we do a due diligence report for you, and you find they fit your risk appetite, the application is then approved. They still are monitored. Their daily transactions are still monitored through their traditional BSA system, but there's the ongoing due diligence pieces that are automated and occur through the RiskScout website, or application rather, where we help with that automation of due diligence collections directly from the clients, all of the adverse media monitoring, automating EDD reviews for you, helping with your variance tracking with for any THC cannabis clients, case management, SAR filings, and so forth. So this is just a little piece of the puzzle of how we help in that situation of really having a robust way of a better customer experience while still being able to maintain what you need to be doing from a BSA AML compliance perspective. Brian, anything else you want to add there?
No, I think you nailed it.
Perfect. We do have one question here, and if anybody, feel free to hit the chat button down at the bottom. Ryan, this is for you probably. Where is the cost for RPA and maintaining the RPA included?
In this one, we did not include the cost in the example. So the idea there was really more of the increase in availability for depositors. If you were to be including, say, just a single RPA and you were using something simple like Zapier or an immediate connection, it would be like a cost per click thing, and it would be probably relatively inexpensive. I'd say under $1,000 a month.
Gotcha. Thank you. I'll give it another minute for questions. And we have on our website, if you go to riskscout.com, there is an emerging market series handouts that are on there. Those really describe for your more I don't want to say desperate, but yeah, underbanked and desperate industries needing to be banked somewhere. There's a 5-part series there that you're welcome to download that gives you the opportunities for fintechs, ATMs, money service businesses, crypto, so on and so forth. And on the back side of those documents, it does have on there all of the risks, or most of the relevant risks, and how to mitigate those risks to your institution. So you're welcome to have copies of that as well. But it doesn't look like we have any more questions, so I think we're going to wrap up here. You will get a copy of this webinar in your follow-up. If you have any questions that you think of after the fact, feel free to reach out to Ryan or myself. And again, those documents are really robust on our website if you're looking for specific market information as well. But thank you for attending, and we look forward to hearing from you soon.